Hi, this is the RITE Report Show, and I'm Chris Angle, and I'm the author of 4 books on philosophy, and they're available at thephilosophicalAngle.com. Along with me is my colleague and co-host, Rick Samuelson. Rick graduated from Yale and has MBAs from Wharton and Tufts, and he's an independent venture capitalist out on the West Coast. And approximately once a month, we put out a report on the state of the stock market and the economy. And this report uses as its basis the RITE Report, which can be seen at stock-market-direction.net. And it's a natural outcome of the book with the title The Philosophical Equations of Economics. Rick, it's good to see you.
And you.
And the RITE Report generates indices from the monthly compilation of corporate, business, economic, and political news snippets. That has a directional bias inherent in the headline, and these news indices and economic indices are used as factors for predicting the stock market. And so we're going to start here by bringing up the RITE Report and see where it tells us for the month of August and for the beginning of September. And we see here, we'll go over the negative economic and general business data snippets. And from the BLS, real average earnings decreased 0.9%. Also, the real average hourly earnings decreased 0.5%. Business applications were down 9.8%. Total business end-of-month inventories were up 0.5%, and total business sales were down 0.3%. World trade was lower, and industrial production decreased, mostly driven by Japan, China, and other Asian economies. Sales of new single-family houses is 6.6% down, and the home ownership rate was lower in the second quarter. The vacancy rate of 6.2% was higher in the second quarter. Advanced international trade deficit in goods increased, and unit labor costs fell in retail trade, and we had 11 negative snippets. In the positive side, Conference Board Employment Trends Index increased. The Federal Reserve Bank of Kansas City released its second quarter energy survey today, which was on the 9th of July, and that was up. Activity continued to outpace the previous year. May 2021 sales of merchant wholesalers was up 0.8%. Average hourly earnings increased 0.3%. U.S. retail and food sales had an increase of 0.1%. Privately owned housing starts was up 6.3%, and new orders for manufactured durable goods increased 0.8%. From Europe, the imports increased. Let's see here. The momentum of world trade stands at 3.1%, and let's see, the end of month inventories were up 0.8%. Retail trade productivity increased 7.7%. Wholesale trade productivity rose 3.6%, and unit labor costs increased in wholesale trade, as mentioned above. The real gross domestic product increased at the rate of 6.5, which is a very key indicator. Personal income increased 0.1% at a monthly rate. Total construction activity was 0.1% above up. New orders for manufactured goods increased 1.5%. Total number of snippets 16. So that was pretty good. So So we had 59% positive and 49% negative. So the news coming to the investor is more positive than it is in negative. Now we're going to go to the economic analysis indicator summary. So we use about 28 of these, and let's see how they came out over the last month. So we have high yield bonds were down. The iShares Select Dividend was slightly down. The Purchasers Managers Index was, although down from a reading of 60.6, was still have a grade score of 59.5. So the economy is expanding, and the IHS Purchasing Managers Index was also expanding, so we're positive there. Construction spending was up 8.2%, that's positive. And unemployment, we divide into 4 sections. The unemployment rate increased to 5.9, that's negative. The civilian force participation rate remained unchanged, okay, that's neutral. The employment population ratio unchanged at 58, neutral. The employment trends index was positive from the conference board, so we're going to put that as a neutral. From the Bureau of Labor Standards, the productivity increased 5.4%, output increased 8.6%, manufacturing productivity decreased 1.7%, output increased 1.4%. Overall, 3 positive, so we're going to give that a positive. And from the quarterly financial report, the profits were up from the latest report. Retail sales was up, an increase of 0.6%. Manufacturing and trade inventories and sales was down. So let's see here, down 0.3%. The total index from the, here's a very important one, the Industrial Production Index from this St. Louis Federal Reserve. The total index upticked from 99.8562 to 100.0950. This is a key indicator that we use. The velocity of money, although it downticked. It's been pretty much in a downslide for a couple years now. Also from the Federal Reserve, St. Louis Federal Reserve. So new residential construction was down. It was down 5.1%. The conference board leading economic indicators increased. And the coincident economic indicators also from the conference board, they increased. New residential sales were down 6.6%. New orders for manufactured goods increased though 2.1 billion or 0.8%. That's positive, great. Existing home sales from the National Association of Realtors was up 1.4%. Real GDP was up 6.5%. Consumption expenditures was up 1%. And personal income was up 0.1%. Consumer confidence from the conference board increased. From the National Restaurant Association, it expanded and was up 1.0% from a level from last month, but overall it's expanding additionally, and so the industry is finally recovering. And from corporate profits from the first quarter was up. We'll probably get the second quarter here next month. New orders for manufactured goods in June was up 1.5%. World trade volume is 0.3% lower, although the momentum increased. But we're going to give it a negative anyway because we feel that the world trade number here is more important. The Federal Reserve National Archive Index from Chicago was up 0.9% or 0.9 ticks. Housing prices rose nationwide in May, up 1.7%. We have 20 positive economic indicators, 7 negative, 1 neutral, and that's an improvement over last month, which was 18 positive. So it's looking pretty good. We're going to comment now on the general economic environment. Domestic political risk, we're going to leave that at -5 because we'll probably discuss this in a little bit after we get through the main report. But the Democrats obviously control the government, and it remains to be seen if this will be what's going to happen here, because 100% of the Republicans are against what's happening, and 100% of the Republicans are generally for what's happening, which is spending a lot of money in the economy. So I don't know if we call it the economy, but it's by the government. So corporate taxes remain in place. This is another key component of what we're going to have to predict here, whether that's going to come on the scene. The individual incentive for of freedom in the economy is we're gonna put that as a -3 because regulations are still increasing from by the Democrats who are in control of this of the executive branch. Production of knowledge is pretty good because of all the government spending, and corporations are doing pretty well, and so they're spending money on research. So that's a positive. And the market continues to go up, so a technical analysis of the market is pretty strong, and the general business and economic snippets that we discussed above is positive, so we're going to give that a +5. And the economic indicators are 20 positive, so we give that a +4. And so our index increases overall from 60% to 60.7, which indicates a positive general direction for the economy. So the Dow is up, and oil is up, although down a little bit in the last couple of weeks. And the U.S. dollar seems to be holding steady. It doesn't seem to be plummeting. In fact, it seems to be on an uptrend presently. So we're going to make, so the RITE Report's conclusion is to stay long. The RITE Report indicators increased slightly this month from 18 to 20 positive economic indicators, and the RITE Report strategy increased slightly from 60 to 60.7, and this economic activity is seen to increase, and so we're going to stay long for this coming month. And inflation, boy, there's a tough call there. Because of all the government spending, there might be a breakout of inflation, but it seems to remain under control. But it seems to be the inflation from if you go to inflationdata.com, it indicates the government indicators are calling for inflation. It indicates present inflation rate is 5.39%. However, the RITE Report does have a new inflation index, and that fell last month from 3.8% to 2%. And the RITE Report Index uses the year-over-year M2 money supply percentage increase minus the GDP minus productivity. And it came out a pretty good rate here this month at 2%, and that's pretty much because of the money, the M2 money supply leveled off this last month, and wasn't going, and the hockey stick type ascendancy that was previous has leveled off, so that helped bring that this percentage down. So enough of me speaking about the RITE report. Let's see what Rick has to bring to the table today. Rick, what do you think of the economy and the stock market now and for the coming month?
Well, as long as real interest rates remain negative, we're going to be in a risk-on investment environment where, as we've seen for many months now, commodities, real estate, share prices, and so forth have continued to rise, although there's been intermittent bits of volatility. I think on balance, probably for the next several months, you're going to see ebullient conditions in all of these markets. That said, the mix of risks is, if anything, increasing. One would expect at this point in the cycle that, for example, you wouldn't have 10 million job openings and 8 million unemployed. This is unprecedented, right? So there's interference by the government in terms of incentives or disincentives that's really distorting the labor market profoundly. And that will have knock-on effects. I mean, you will see pressure for wage increases. We have seen that already in these conditions for as long as they last. And the $3.5 trillion bill that the Democrats want to pass would only worsen this sort of dynamic, not address it. The emphasis there is on eliminating poverty, paying people, in many cases not to work, and that's been a continuing policy. So, that plus the attempts at increasing taxes dramatically in that bill, it will cast a pall over market expectations going forward. It remains to be seen whether the bill is passed or how soon it's passed or what form it's passed in and what elements of it get excised or altered and what have you. But it's a level of spending that we haven't seen before. I mean, it's equivalent to what used to be the entire national federal budget for 1 year. And even though it's spread out over time, it's still an absolutely gigantic number that includes all kinds of regulatory incentives, disincentives, direct intervention in the economy, subsidization of green industries and so forth that present their own problems. But add to that the fact that Asia has been hurt very badly already by this new COVID variant, the Delta variant, and is poorly vaccinated and won't address that quickly. There are just too many people, and the vaccines aren't effective enough, unfortunately. And I think you're going to see a disruption in the vital supply chains all across, not just China, but across Asia for the next few months. So that also will induce inflationary pressures that business will have to cope with. So it's not, the economy is not, as one would expect at this juncture, firing on all cylinders with no clouds on the horizon, as you might have seen, during the 80s when Reagan came into office. There are quite a few risk factors, and I won't even mention the geopolitical risk of a Taiwanese invasion by China or something like that. Iran doing something ill-advised in the Middle East, consistent with their ongoing threats and so forth. So with valuations as high as they are, in my corner of the investment universe, which is basically one of the higher risk ones, we're seeing double the level of venture capital funds going into the U.S. market that we saw last year, essentially double. So we're hitting all-time records, which indicates that the appetite for risk, has literally never been this high. And as a consequence, valuations have never been this high. And when you have, peak valuations coming at so early on in a recovery cycle, it begs the question, what goes up can quite easily go down, and quite quickly. So, I caution investors that at a time like this, it pays to be, even more prudent and even more selective. We are routinely discarding most of the early stage companies we look at just on the basis of high pre-money valuations. They've gone too high, and so the opportunity for a decent internal rate of return is much less. But if you hunt and peck and find the good ones that are reasonably priced, you can still have a sustainable business model.
Rick, what do you think has led to the high valuations? Why has it gone up so much?
Negative real interest rates. I mean, you have to go back in time, quite some time, to find a sustained environment of negative interest rates, the likes of which we've had recently. Interest rates generally are very close to zero. Inflation is certainly above 2%, and some would say 5%. So interest rates are profoundly negative by any measure. And so it's hard to see how, any institutional participant in the market is going to, at the margin, prefer a bond investment over something else, whether it's early stage company investing, or the stock market, listed equities, or commodities, or real estate, or what have you. Now, were that to reverse, were interest rates to normalize, because I don't think the current conditions are sustainable, that would present a gigantic blow to these valuations. And I don't think it would take much of an increase to really crush all of these markets. Call it 100 basis points, and I think you'd see a very dramatic swing. So that's a principal risk. Not that the Fed will certainly strive not to allow that to happen, but the Fed doesn't control everything. So interest rates can pop for a variety of reasons.
Okay. Hey, so you also talked about Asia influence. What do you see about this downturn in Asia? Is it going to affect? Is there a possible effect on the New York Stock Exchange and the stocks of the United States?
Yeah, definitely. Asia has become such a large part of the world economy that you just can't ignore it. It's far more important than Europe is, for example, and especially in terms of world trade. So, to the extent that the supply chains are interrupted, prices can pop here and there. Intermediate goods prices can pop here and there, and where there's scarcity, Asian demand's being affected, so that'll affect U.S. and European exports. Can they muddle through this and maybe improve their vaccination rates over, say, a 6-month time frame? Yeah, quite probably, but you could very well have quite a bit of choppiness in between. As we've seen, these vaccine rollouts don't go quickly.
Right.
Anywhere.
Right.
And in Asia, there's the ability to get to some of the rural populations is quite, difficult, and the medical facilities available are not as robust. So, it makes it even harder. And add to that, the Chinese vaccines are, less than half as effective as the Western vaccines.
Yeah.
So you may have to end up vaccinating multiple times to achieve the same level of effectiveness.
Okay. So to sum it up, Rick, how do you look at the short-term outlook for the New York stock for the United States stock market?
Well, I think there are going to be better buying opportunities in the future. I think this cycle has run much of its course. I'm not sure it's going to collapse next week, but I think there will be. I think if you're going to have a long portfolio, you should have some short options as well, because any of a number of factors could punch the market down, and there are ways to profit on the downside too.
Right. Okay. Very good. All right. Thanks for that, Rick, and we'll see everybody next month on the next edition of the RITE Report.
Thank you.